And then the third way is private lending.
Private lending, which I've been doing since 1980, as Byron mentioned. Private lending is more expensive. Typically, they lend less of loan to value than a bank will. As you know, on some real estate loans, especially home loans, right? The banks may be lending 100%. You know, USDA, VA, FHA with the 3% down, conventional with 5% down. So private lenders usually lend less of the loan to value based on appraisal. The loan to cost varies. It may be 80%, it may be 90% loan to cost. So they look at both the loan to cost and loan to value on the completed value or the after repair value if you're fixing up a property. So that's what a private lender does. The neat thing about private lending is that we get to help borrowers finance projects that maybe would not make it through the bank. And there's all kinds of reasons why a loan is not bankable. It could be timeliness in the closing. Banks are not extremely fast. And even some small community banks, and we used to pride ourselves at Metro Phoenix Bank of being fairly fast for a community bank. But you're still probably looking, 3 to 6 weeks. Sometimes an investor will have an opportunity, buying it through a trustee sale or a wholesaler, and trustee sells 5 o'clock the next business day. Wholesalers usually will only give you 10 days to close if you're buying a property from a wholesaler. So private money comes in from timeliness of closing. It also may be the borrower's FICO score. Maybe they went through a divorce or a partnership breakup, a dispute, and their FICO score was affected. Now they're not going to be able to borrow money from the bank. Also, income. Private money does not do debt to income ratios. Some private money lenders don't even ask for tax returns. We just want to make sure you're filing, so we just ask for the first 2 pages to document that you are filing. We don't want the IRS to be a problem behind our loan, so we at least want to do that amount of due diligence. But we don't ratio our borrowers. So if you're going to a bank, and even a community bank, their ratios may be higher than Chase, but they're still going to go through that process. They'll actually, if you have several businesses, they'll do a global cash flow. If you have 3 or 4 businesses, they're going to take all your income and expenses from all those businesses and see how you do as a whole. We don't do any of that. So we do pull a credit report. We're not a FICO lender. It does pull our OFAC and FinCEN reports, and while we don't require a FICO score, as most traditional lenders do, when we report to HMDA, which is a government required reporting for any occupiable dwelling loan, we do have to put a FICO score down. So we may not care, but the government does care that we put a score in there. The FinCEN and OFAC is just the bad boy list that the government requires us as lenders to check before we lend you money for money laundering purposes. So make sure you're at least not a bad person.
Right.
So.